Joined by Assocate Professor Mark Humphery-Jenner from the University of New South Wales in Sydney. Mark, good to have you with us. I have to ask, does the demise of SVB say more about the downturn in the tech sector or the risk profile that SVB was actually taking on?
Well, first, thanks for having me. And in relation to SVB's collapse, it has been a little bit of a slow-moving trash fire to some extent. And it really says a couple of things about how the organization was run. So we have its underlying deposit book. So what SVB did, as the name suggests, is it's primarily working within the tech sector, the startup sector, and the venture capital industry. This means a lot of its depositors were tech firms, venture capital-backed firms, the types of firms that are all exposed to significant economic shocks. So if we're entering into a slow economic period, interest rates are going up, many of these firms are really quite significantly hurt. So these firms were perhaps removing their deposits just to pay for payroll and their suppliers. Furthermore, they were depositing less money into SVB, which meant that SVB's ultimate cost of capital needed to go up. They needed to get money from elsewhere or needed to pay higher interest rates to depositors to encourage them to put money into the bank. And this means that SVB's exposure, being so heavily concentrated really within one sector of the economy, made them very vulnerable to what ultimately happened. And therefore, we're seeing a couple of things play out. Firstly, we do have this slight downturn within the startup space, which then ultimately impacted SVB. And then SVB compounded this by concentrating itself really within that space that was going to be always vulnerable to these economic shocks. And this meant that SVB had a very shaky foundation on which it built the rest of its asset portfolio, making the whole situation worse from a very precarious pedestal to begin with.
So it sounds to me like the startups in SVB are not out of the woods yet. We've had the Fed announce a new lending facility yesterday and assure that depositors will be fully repaid. But is this the end of concerns for Silicon Valley startups?
So Silicon Valley Bank is effectively going to go under. And what has happened here is the Federal Reserve and Treasury have stepped in to reassure depositors. In a joint statement, the Federal Reserve and the Treasury Department indicated that all depositors at Silicon Valley Bank would be made whole. That includes all depositors, even those who have deposits above that $250,000 limit that would ordinarily apply to deposits. This reassures a lot of those startups and a lot of the suppliers to those startups. After all, if the deposits weren't guaranteed, then think about all of the suppliers. Will those suppliers actually do business with the startup if that startup might not even have money? What about employees? Will those employees start looking for a new job? Or what about those companies' own lenders? What will those lenders do? So the decision to guarantee all of those deposits was probably quite vital, not just for the startup space, but for the broader small and medium enterprise space within the United States. So this step in then helped to alleviate some of those concerns. Many of these startups aren't necessarily out of the woods. They've managed to sidestep Silicon Valley going under. They've managed to avoid that train wreck, but they still have the economic situation they need to deal with. They still need to deal with the ongoing problems the startup sector is facing, such as a slowing down economy, such as valuations declining, such as it being more difficult to get enterprise-level sales, which has made the sales cycle much longer and increased their need for cash. So they still have the latent economic problems. It's just that they're now out of the woods in terms of their deposits. They also are, to some extent, going to face some issues with getting rebanked, because Silicon Valley Bank is likely to go under or maybe be acquired and then reorganized. One of the issues, however, is that Silicon Valley Bank was in the practice of providing what's called venture debt, which is some debt to early-stage startups. This notably only really applied within the United States, not outside the US, in relation to Silicon Valley Bank. And therefore, some of those companies who were banking on that venture debt to maybe get access to some trade credit, well, those firms are going to need to find an alternative. So there will be a little bit of a cash flow crunch for some of these startups.
Mark, what about the cryptocurrencies? How will they impact the highly volatile sector, given that Silvergate, Signature were two main banks for crypto companies, while SVB had a lot of crypto startups and VCs as customers?
Absolutely. So none of these banking collapses are good for anyone, including for crypto companies. Now, Signature and Silvergate both focus significantly on the crypto industry, and their collapse to some extent directly impacts the crypto industry and more indirectly impacts it. The reason it can indirectly impact it and have an on-flow effect is many crypto firms have traditionally faced significant problems getting into the banking sector. Many banking firms don't actually want to deal with crypto investors or crypto organizations more generally, because then they need to go through a whole lot of layers of regulatory compliance, and sometimes it's not even worth the effort. And no bank wants to be that token bank that is accidentally engaged in some anti-money laundering practice, or money laundering practice rather, and gets caught up for it. So therefore, banks traditionally haven't been super fond of going into the crypto space. Silvergate and also and Signature then went into this space to try to provide some banking services. Their collapse then is a massive blow to many of the crypto investors that would have been using those firms and now need to find an alternative. If we're looking at Silicon Valley Bank, well, Silicon Valley Bank had less exposure in the crypto space. Now, granted, when it went under, USDT did lose its peg, albeit just slightly. And this suggests that there is some exposure, both for crypto firms, but also for the general sector in terms of the feeling about positivity or the lack thereof about what's going on within cryptocurrency. And many of these startups themselves were at least adjacent to the crypto industry or adjacent to the NFT industry, which then creates a broader cascade effect. But Silicon Valley Bank itself has a relatively muted impact directly on the crypto industry currently.
Mark, we've run out of time, but it's very good to get the details about the contagion effect of SVB. And that was Associate Professor Mark Humphery-Jenner, University of New South Wales.